When you're looking to buy a business, you need a roadmap. You can't just walk in blind and hope for the best. That roadmap is the Business Opportunity Memorandum, or BOM. Think of it as the complete story of a business, all written down in one place. It's a detailed document prepared by the seller to give potential buyers a deep, comprehensive look into their company. It goes far beyond a simple sales flyer. It's the full disclosure, the good, the bad, and the ugly. This document is the starting point for any serious conversation about an acquisition. It lays all the cards on the table so you can begin to make an informed decision. The purpose of a BOM is to build trust and provide clarity. For the seller, it's their chance to put their best foot forward and showcase the true value of their operation. For the buyer, it's the primary tool for initial due diligence. It answers the fundamental questions you should be asking. What does this business do? How does it make money? Who are its customers? What makes it special? Without this document, you are essentially flying blind, relying on hearsay and gut feelings. A well-prepared BOM shows that the seller is serious and organized, which is a good sign from the very beginning. It's about creating a transparent process for everyone involved. This isn't just a document for buyers either. Lenders, the people who provide the capital to make these deals happen, rely on it just as heavily. A lender needs to understand the risk they are taking on. They need to see a clear path to getting their money back, with interest. The BOM gives them the evidence they need to assess the company's health and its ability to handle new debt. It provides a snapshot of the business's past performance and a projection of its future potential. It's the single most important document for both the person buying the business and the institution financing the purchase. Ultimately, the BOM is about managing the three most important things in any business deal: people, process, and product. The memorandum introduces you to the people running the show and the team that makes it all happen. It breaks down the processes that drive revenue and create efficiency, or in some cases inefficiency, and it explains the product or service, detailing its position in the marketplace. This document is your first real test. It helps you decide if a business is worth your time, your money, and your effort before you spend thousands on accountants and lawyers for deeper due diligence. It's the foundation of a smart investment. Let's break down what you'll find inside a Business Opportunity Memorandum. The first part you'll see is the business overview. This is the high-level summary. It tells you the company's history, its mission, and its legal structure. You'll learn about its core products or services and what makes them unique in the market. This section should give you a clear, immediate understanding of the business's identity. It's the first chapter of the story, setting the stage for everything that follows. Pay close attention here because if the basic story doesn't make sense to you, the rest of the details won't matter. Next, you'll dive into the financial analysis, which is the heart of the BOM. This isn't just a single number, it's a detailed look at the company's financial health over the past 3 to 5 years. You'll see the income statements, which show profitability. You'll examine the balance sheets, which reveal assets and liabilities. And you'll study the cash flow statements, which tell you how money actually moves in and out of the business. This is where the numbers have to tell a consistent and believable story. Look for trends. Is revenue growing? Are profit margins stable? Is the business generating real cash? Then comes the operational breakdown. This section explains how the business actually works day to day. It details the key processes, from marketing and sales to production and customer service. You'll learn about the management team and key employees, the people who are essential to its success. This part of the BOM should also describe the company's assets, like property, equipment, and intellectual property. It's where you get a feel for the moving parts of the machine. You need to understand the process to know if you can improve it or if it's already running as efficiently as possible. Finally, the BOM will outline future opportunities and potential risks. The seller will present their vision for growth, such as plans for new products, market expansion, or operational improvements. This is where they try to sell you on the future upside. But a good BOM is also honest about the challenges. It will discuss investment considerations, competitive threats, and other potential hurdles. This transparency is crucial. You want to know the risks up front so you can evaluate whether you have the skills and resources to mitigate them. A business without problems doesn't exist. What matters is whether the problems are solvable. As a potential buyer, the BOM is your primary investigation tool. Your job is to read it not just as a sales pitch but as a puzzle. You are looking for the story behind the numbers and the text. Start by verifying the claims made in the business overview. Does the company's reputation in the market match the description in the document? Do a little preliminary research online. Look at customer reviews. See what former employees are saying. The bomb is the seller's narrative, and you need to cross-reference it with reality. This is your first chance to spot any red flags or inconsistencies before you get too deep into the process. Next, you use the bomb to identify opportunities for growth that maybe even the current owner hasn't seen. The seller will list their own ideas for expansion, but you should look for more. Scrutinize the operational section. Is their marketing process outdated? Could you implement new technology to improve efficiency and cut costs? Are they underutilizing their customer list? The financial analysis might show a strong product with weak profit margins, which could be an opportunity for better pricing or cost controls. This document isn't just about buying a business as it is, it's about seeing what it could become with your leadership and investment. Of course, with opportunity comes risk, and the bomb is your first line of defense in identifying it. Pay close attention to customer concentration. If 80% of the revenue comes from a single client, that's a massive risk. What happens if that client leaves? Look at the key employees. Is the entire business dependent on the owner or one superstar salesperson? That's another risk. The financial statements might reveal declining sales, shrinking margins, or mounting debt. The bomb should be honest about these things, but you need to read between the lines and connect the dots yourself. Your goal is to build a complete picture of all the potential downsides. Finally, the bomb helps you formulate a preliminary valuation and your initial offer. After analyzing the financials, the assets, the growth potential, and the risks, you can start to get a sense of what the business is truly worth to you. You can use the financial data to apply standard valuation multiples for the industry. This is also where industry benchmarking comes in. The bomb might provide comparisons to similar companies, but you should do your own. How does this company's performance stack up against its competitors? This data-driven approach allows you to make an offer that is grounded in facts, not just emotion. Lenders look at a business opportunity memorandum with a different set of eyes. While a buyer is focused on upside and opportunity, a lender is focused almost exclusively on risk management and the capacity to repay a loan. Their first question is always, can this business generate enough consistent cash flow to cover its existing expenses plus the new debt payments? They will pore over the historical financial statements, the income statement, balance sheet, and especially the cash flow statement to answer this question. They are looking for a track record of stability and profitability. A history of volatile earnings or negative cash flow is a major red flag for any lender. The lender also uses the bomb to assess the quality of the company's assets. The balance sheet is critical here. They want to see what they can use as collateral for the loan. Are there valuable assets like real estate, machinery, or accounts receivable? A business with significant tangible assets is a much safer bet for a lender than one whose value is tied up in intangible goodwill. The lender will perform their own appraisal of these assets to ensure they are not overvalued in the bomb. They are building a safety net. If the business fails, they need a clear path to recovering their capital by liquidating these assets. Furthermore, lenders analyze the operational strengths and weaknesses detailed in the bomb to gauge the business's resilience. They look at the management team's experience and the stability of the workforce. A strong tenured management team suggests that the business can continue to operate smoothly after the sale. They also look at the company's market position and customer base. A diversified customer base and a strong defensible position in the market are signs of a durable business. Lenders are not interested in speculative ventures. They want businesses that are built to last through economic ups and downs. The bomb provides the core evidence for this assessment. In summary, for both buyers and lenders, the Business Opportunity Memorandum is the cornerstone of a sound business transaction. It provides the buyer with the necessary information to evaluate risks, identify opportunities, and make a fair offer. At the same time, it gives the lender the data required to assess the company's financial health and its ability to support new debt. A thorough, transparent bomb fosters trust and allows all parties to make informed, intelligent decisions. It transforms a potentially emotional purchase into a strategic, fact-based investment. Without it, you're just gambling. And in business, you never want to gamble when you don't have to.